The real John here. Quick word before we get into it, especially for anyone who's new. There are copycat channels out there mimicking this format, this cadence, even the way the information is framed, trying to funnel people into paid groups, signals, memberships, or courses. That has never been this channel, it isn't now, and it won't be later. There's nothing for sale here. No alerts, no promises, no shortcuts. Just data, context, and analysis. If you understand that, drop the real John in the comments so I know you're actually locked in. If you've got questions, post them. I read everything. Comments, messages, emails. If something matters, we bring it to the table. Now let's talk, because the timing of this matters more than most people realize. Sunday nights before a Monday open are when markets quietly tip their hand. It's when the headlines start leaking before price is allowed to react. And right now, there's a situation developing that most financial media outlets are either ignoring or deliberately compartmentalizing so people don't connect the dots. Mexico is not just having a bad news cycle. It's dealing with a fast-moving disruption. Military deployments, airspace restrictions, flights canceled in key regions, and a high-level operation that reportedly removed one of the most influential cartel figures in recent memory. The political implications will be debated endlessly elsewhere. That's not what we're here to do. What matters here is what that disruption represents structurally. Mexico is not just another country in the commodities world, it is the single largest silver producer on Earth. Roughly 25% of all newly mined silver globally comes out of Mexico. That is not trivia. That is a foundational pillar of global silver supply. When transportation routes are interrupted, when regions lock down, when security risks spike, you don't need mines to shut overnight for markets to react. Mining supply chains don't break all at once. They strain first, they delay, they become unreliable. And in a market that is already tight, uncertainty itself becomes the catalyst. Silver right now is not priced for disruption. The paper price reflects a continuation of normal flows from the world's largest producer. It assumes trucks keep moving, ports keep operating, and logistics remain intact. But commodities don't wait for confirmation. They move on risk. And when risk enters the equation in a market that already has limited slack, repricing doesn't require catastrophe. It requires doubt. That doubt is now present, whether headlines want to acknowledge it or not. This matters even more when you zoom out and look at positioning. Speculative long exposure in silver has been sitting near multi-decade lows even as price has pushed higher. That's not a crowded trade. That's not retail mania. That's a market moving without enthusiasm, driven by underlying physical demand rather than leveraged speculation. Add to that the persistent premium coming out of Shanghai, which has been signaling for weeks that physical metal in Asia is commanding higher prices than paper markets in the West. When physical leads and paper lags, the adjustment usually comes fast once it starts. Now, layer in something most people don't look at on weekends. While traditional gold and silver markets are closed, crypto never sleeps, and gold-backed tokens, particularly those that track physical gold one-to-one, act as a real-time sentiment gauge when futures desks are dark. As of this recording, one of the largest gold-backed tokens is trading roughly $50 above where Western spot gold closed on Friday. That doesn't mean Monday has to open higher. Markets can gap and reverse. Liquidity can distort pricing. But it does tell you something important. Participants who want gold exposure right now are willing to pay up when traditional access points are unavailable. That's forward-looking behavior. It's not confirmation, but it's information. And informed markets are built on information, not guarantees. When you see that kind of premium develop before institutional desks have even powered up their terminals, it suggests demand pressure is present before price is allowed to express it through normal channels. If that pressure carries into the open, the first real test for gold isn't some moonshot target. It's the prior week's high, specifically the high set midweek, which also coincides with a previous weekly high. Markets remember those levels. They act as checkpoints. Clearing them matters for momentum. Failing there matters too. This isn't about predictions. It's about understanding structure so you're not reacting emotionally after the move has already happened. There's another critical context point most people will miss. Shanghai is closed on Monday and doesn't reopen until Tuesday. That matters because Shanghai is the largest physical precious metals marketplace in the world. When it's offline, global liquidity is thinner than usual. Thinner liquidity amplifies moves in both directions. A rally can look stronger than it truly is, and a pullback can look more violent than fundamentals justify. For anyone operating on shorter time frames, that's not an invitation to be aggressive. It's a warning to be cautious. Light liquidity distorts signals. Silver's structure going into this week is still intact. The tape hasn't broken. The next level the market naturally gravitates toward sits just above current price, aligning with a prior weekly high. When technical levels overlap with historical price memory, they carry more weight. Above that sits a broader resistance zone, an area where price cannot afford to linger. Silver does not benefit from camping inside resistance. If it reaches that zone, it needs to move through with authority or risk losing momentum altogether. That's how this metal behaves historically. Slow grinding through resistance drains energy, sharp moves clear it. But here's where this stops being just a weekend pricing story and starts connecting into something much larger. Over the past several months, a quiet shift has been unfolding beneath the surface of global markets. The US dollar's share of global reserves has fallen to its lowest level in over 3 decades. At the same time, central bank gold holdings have surpassed treasury holdings for the first time since the 1990s. That isn't coincidence. That's a structural reallocation of trust. Now add what's happening on the COMEX. With only days left before last notice on the February gold contract, open interest remains extraordinarily high. Over 400,000 ounces of gold are still represented by open contracts, far exceeding what is typically seen at this stage of a delivery cycle. In fact, it's multiples above the historical norm and even larger than the upcoming active contract month. That kind of imbalance is not routine. It suggests a participant or participants holding short exposure far longer than expected, likely hoping liquidity would appear to provide an exit. But liquidity didn't show up. Volume dried up, and now the question becomes unavoidable. Does the short side have the physical metal required to meet delivery obligations? Historically, when this situation arises, one of two things happens. Either a major bullion bank steps in to issue delivery notices to prevent a visible failure, or the market is forced to reprice rapidly to flush out the imbalance. Neither outcome is neutral. Both introduce stress. This isn't speculative storytelling. There is documented precedent. Decades ago, authors who described concentrated short positions in precious metals markets were dismissed as fringe voices. Since then, we've seen regulatory settlements, enforcement actions, and outright admissions confirming that price management through paper leverage was not only real, but institutionalized. Fines in the hundreds of millions of dollars were paid. Cases were closed. The behavior was acknowledged. The only thing that didn't change was the public narrative. When current market structures begin to resemble those historical pressure points, it deserves attention, especially when it's happening against a geopolitical backdrop that is anything but stable. The situation involving Iran hasn't resolved, it's shifted. Diplomatic language has softened, but military assets remain positioned in numbers that suggest optionality, not withdrawal. Markets are not pricing full-scale conflict, but they are not pricing resolution either. Precious metals live in that uncertainty gap, and underneath all of this sits a deeper monetary transition. For decades, the global system relied on the US dollar and treasuries as the primary reserve assets. That arrangement allowed the United States to run persistent deficits while exporting inflation abroad. Foreign buyers absorbed debt issuance. Domestic consumers benefited. That system depended on trust. The freezing and seizure of sovereign reserves changed the risk calculation permanently. Once reserves can be weaponized, they are no longer neutral. Central banks didn't respond with press releases. They responded with balance sheet decisions. Gold began replacing treasuries. dollar share declined. That shift means less inflation is exported and more stays domestic. That isn't ideology, it's arithmetic. Analysts warned years ago that when reserve privilege erodes, inflation comes home. The data now shows that process underway. None of this means prices move in straight lines. There are valid counter-arguments. Thin liquidity can produce false signals. Mexico's situation, while serious, has not yet produced confirmed output losses. COMEX anomalies have been managed before without triggering systemic events, and long-term valuation models that point to extreme prices operate on timeframes that test patience and capital discipline. Being right eventually is not the same as being positioned correctly today. Understanding cycles matters. Direction and timing are separate skills. Confusing them is how people with accurate macro views still suffer unnecessary losses. This channel isn't here to sell certainty. It's here to provide context so you can think clearly when volatility arrives. Taken together, the picture is this. A major silver-producing nation is experiencing sudden instability. Physical silver markets were already tight. Gold-backed instruments are signaling demand before traditional markets reopen. Delivery structures in gold are showing rare stress. Central banks are rebalancing away from dollars. Geopolitical risks remain unresolved, not eliminated. And global liquidity conditions are shifting. This isn't noise, it's a pattern. And patterns matter more than headlines. Verify everything. Look at the data yourself. The delivery reports are public. The reserve statistics are published. The premiums are observable. Logic beats hype every time. Stay sharp, stay patient, and stay grounded in facts, not fear. The real John out.